Hello there, and welcome to the Wealth Roadmap Briefing for July 2026. Based on client feedback, we're going to be making some changes to the format of our monthly video here going forward. We want to spend a little less time speaking about generic financial education and market news, and spend a little bit more time talking about the lessons, decisions, and choices that we're seeing our clients making. We have the privilege of working with 133 successful families. And although we understand that each and every family is unique and different, there are common decision points and things that do happen on life's journey. And we want to be able to share those insights so that we can all learn together. In today's video, we're going to cover off 4 conversations that we're having. The first of those conversations we're entitling Navigation. These are smaller checkpoints along the way that clients are seeing in their wealth roadmap. The second, we're going to be called the Crossroads. We're going to offer some perspective and observation about major life events, decisions, and transitions. The third, we've entitled the Engine Room, which is a monthly market and portfolio update. And the fourth is called Observations from the Journey, which is a general observations that we've made over time, as we've worked with each and every one of you. Now, as we continue to develop this monthly video, if you have any further feedback, we'd love to hear it. As well, if there are any questions you have on any of the segments that we're discussing here today, please reach out and it would be great to hear from you. Now, there's a lot to cover, so let's get right into it. One of the topics that came up frequently over the course of July on clients' wealth roadmaps was that of RESP withdrawals, or Registered Education Savings Plan withdrawals. Now, it's not surprising, September's approaching, and parents and grandparents want to ensure that funds are in place to cover off education costs. In terms of RESPs, there's 3 insights that we can offer here. The first is that it's very important to use up an RESP over the course of your child or grandchild's education. The money left inside of an RESP eventually is forced to be withdrawn, and there's some very negative tax consequences. So you definitely want to address that proactively. The second is that getting money out of an RESP is simple. It's mechanically very easy. We just need some documentation from the registrar, and then there's some administrative tasks on our end that are very, very routine and straightforward. So that's very simple to do. The third insight that we want to share is that although getting money out of an RESP is very, very easy, getting the most value out of an RESP takes a little bit more work. We always want to take a look at the family's entire situation in terms of each child's educational path, the number of children, etc. Because inside of an RESP, there are some mechanical things around each of these little sub-accounts that the government tracks, like the education assistance payment and your contributions. And these things are all taxed differently. And what we want to ensure is that you're getting the most value out of the RESP possible by looking at lower taxes, as well as increasing flexibility and ensuring that funds are around for each child to help them with their education. So if one child has a more expensive educational path and another one is cheaper, that would alter the advice that we give about how to withdraw from an RESP. So it's not just about getting money out, it's about creating flexibility and getting the most value we can. Another conversation we've been having with clients over the last few months revolves around retirement income. Now, we've observed this on a couple of occasions with some new households that have joined us. But what we've seen very often is that over time, when someone retires, is they choose a level of distribution that they want from their portfolio, and they keep it at that level. And that can be fine. However, we do know that life changes, spending changes, etc. And this actually does create an issue, because over time what we are observing is that in these households that very, very large amounts of cash are beginning to accumulate in things like checking and savings accounts. Now, one could facetiously say, hey, that's a fabulous problem to have, and I feel really good about that problem. And and there's a level in which I think we all relate to that type of an idea. However, that money and those resources sitting in checking and savings accounts do open up some inefficiencies, and they do create a risk, because those are resources that could be used to support family, could be used for legacy, or could be used to support further retirement income if required. And having money sitting in an account where it's losing value each and every day to inflation may not align with your long-term financial goals. Now, this is not saying that having security cash in an account is a bad idea. However, what we want to bring, the key insight we want to bring here is just really looking at the idea that, is that cash intentional? Does it actually reflect my long-term goals? Does it reflect my views on leaving a legacy, retirement income, and financial security? And if it does, great. And if it doesn't, then that's a discussion that we should have so we can ensure that all of your wealth is serving you as efficiently as possible. In terms of our crossroads segments, where we discuss major life events, transitions, and decisions, what I wanted to talk about here today was inheritance. Now, we know that over the next decade, a lot of families are going to be receiving inheritance as the elder boomers pass on and move that wealth down to younger generations. Now, a lot of the time when we see clients that are receiving inheritance, we get a lot of questions, and a lot of those revolve around things that are what I'm going to term tools, right? We get questions around what should I invest it in? Should I make a major purchase? My friend told me about this tax structure or this family trust, etc. And those are all very, very important questions. Taxation matters, major purchases matter, investments matter, and we absolutely have to get that right to ensure that you get the most benefit out of that inheritance. However, there is a bigger picture question that we also need to step back and talk about. And there's actually two questions that are kind of interrelated here. The first question we need to ask is, what options does this inheritance give me that I didn't have before? And the second one is, which one of these is in alignment with my values and vision for my life? Now, for some families, either their net worth is too high or the inheritance is too small, and it just doesn't move the needle. It doesn't create any other options, and it just reinforces the financial situation they already have. For other families, this will be life-changing. This will allow decisions around becoming work optional or retiring. It'll allow decisions around helping children with a first home or a gift, or it'll allow decisions around a major purchase. And each and every single one of those options has a lot of different implications about how and when money should be deployed. And that's very, very important in planning, because all of the tools that we can talk about are very, very important. But if they don't support the goal that you actually want to pursue, then they're just not helpful, and they're not going to help you get where you need to go, irrespective of any benefits that they have. So when we're thinking about these sorts of things, we always want to begin with the end in mind and think about where we want to go, and then think about what tools will help us on the way. In this segment we've entitled The Engine Room, we're going to provide some perspectives on both markets and portfolios, as well as touch on any frequently asked questions that we see over the course of the month. Now, in July, we got a reminder that markets very rarely move in straight lines. And after a very, very strong first half for both markets and portfolios, we did see a bit of a pullback. Nothing terrible, but really what I would classify as normal 3-step forward or 4-step forward, 1-step back type of action. So we should see this as being normal and expected. We know that markets that go straight up aren't healthy, and it's very normal and healthy to have a pause that refreshes. Now, over the course of July, and frankly from earlier in Q2, we did make some adjustments to portfolios. We did have allocations that we took on during the March-Iran conflict drawdown in the semiconductor space that did have produced some very, very good performance. And over the course of the late in the second quarter and into July, we did take profit from those positions. Specifically in July, we sold our technology ETF and our momentum ETF. They were under the symbols XLK and SPMO. And we bought a value factor ETF, symbol IWD, and a small cap ETF, symbol RSSX. So what we want to do there is simply take some profit from an area of the market that has run very, very far, very, very fast, and is likely to take a pause, and reallocate it to other parts of the market that we believe can do better. We also took the opportunity when we made these trims to allocate cash for future opportunities, and we'll call back to that point here in a moment. Now, one of the most frequently asked questions that we saw over the course of July, and really the only core question we saw, was about outlook. So in order to talk about outlook, I always want to give the disclaimer that, look, I don't have a crystal ball and that I can only speak in probabilities. However, if we take a look at both the short term and long term, we really have to come away to be positive if we're looking at the long term. Now, in the short term, it would be very historically normal if we did see some volatility ahead of the US midterm elections. Now, that might be starting this month, but the bottom line is that would be historically normal, and nothing to do with our the current U.S. administration, and it's something that has occurred really throughout recorded history. And so that's something that we have prepared for, again, by adding a little bit of cash to the portfolio, because this would be the opportunity that we're looking for to get it to work. Now, the reason we want to get it to work is that in the long term, I think that there's a very, very constructive scenario that's at play. From a fundamental basis, we're seeing some very, very key positives, right? The U.S. economy continues to grow at a good rate. Corporate and profit margins are going up, And if we look at the slide from Fundstrat Capital, we can see that U.S. corporate earnings are moving up at a very, very high pace. We see that for the whole S&P 500, year-over-year earnings growth is estimated at 25%, and that's being driven by the biggest sector, which is technology, with a 62% year-over-year earnings growth. Now, we're in Calgary, so I always want to call out the energy sector, and we can see that even though that's a very, very tiny sector in the S&P 500, the year-over-year boost in oil prices certainly helped out in that area. Now, because of these fundamental this fundamental strength, what we've seen actually is a phenomenon where earnings growth is actually accelerating faster than the indexes are going up. So believe it or not, the market may be higher than it was in January, but it's actually gotten substantially cheaper. The other group of reasons where we're positive here as we look out over the next 9, 12, 18, 24 months is there's a group of what we'll call technical signals that we want to take a look at. And those technical signals are comprised of a few things. The first is sentiment. Now we know that sentiment is a contrarian indicator. When investors are feeling subdued, they're feeling pessimistic, future returns tend to be good. And when investors are feeling optimistic, future returns tend to be poor. Currently, right now, investor sentiment is pretty low, and we know that it's very fragile. When it starts to pick up, the market has even a bad week, and then it collapses back down again. That's a positive long-term indicator. The second thing we want to look at from these technical signals is these quantitative studies of market behavior. And they all, almost without exception, do point to very, very strong returns over the next 1 to 2 years. Now, these things are never guarantees. They are pattern recognition. And again, there's always the old explanation about correlation isn't causation. However, I do like them because they do remove emotion from the decision-making process. And it always is, when we're talking about two things that are interrelated, which is, A happens in the same market, then B happens in the same market, right? There is something likely going on under the surface, even if that thing is not apparent to us now and only apparent in hindsight. So again, the bottom line is that, although the short-term outlook might be opportunist, it might be a little bit subdued, the long-term outlook is extremely strong. And we definitely want to use any volatility that we see to put cash to work so we can take advantage of those good long-term fundamentals. And we know that we live in a very noisy world. Headlines are going to change, wars are going to start, they're going to stop, they're going to start again. And what we want to always emphasize is that in these type of times, process is going to beat prediction every single time. In this segment, which we're entitling Observations from the Journey, I wanted to make an observation about retirement and how it can be hard for some clients. Now, over the last 20 years, I've had the privilege of helping clients to retire and to stay retired. And one of the things I noticed is that there's this recurrent pattern, which is very, very frequent. And that pattern is that a client will retire. They will stay retired for some period of time, whether that be 6, 12, or 18 months. And then I'll get that phone call on a Wednesday afternoon saying, Conrad, I just want to let you know I'm back at work. And you know what? That's very, very understandable. People who are driven, have achieved things their whole life, don't want to stop contributing to society and to the world just because they're not working for money anymore. And that's why, as we're working through retirement planning, it's important to ask a significant question. That question is, it's not necessarily what you're retiring from that's important, it's what you're retiring to. Because that's going to give you the next phase of the journey that you're on. And also, from a practical level, if we know that what you're retiring to, we can help you define what that is in financial terms. We can plan, we can make it happen, and we may even discover that the absolute number of dollars in your investment accounts aren't the most important determining factor, that there are other things that we have to consider. And that can be very, very important for your wealth roadmap as we go forward. Thank you for joining me for this month's Wealth Roadmap Briefing. As we discussed in our introduction, we're making a change to the format here of this monthly video, so if you have any feedback, we'd love to hear from you. Also, if you have any questions on any of the segments that you saw here today, please reach out and reach out to us. We'd be happy to have a conversation on it. And until next time, again, thank you again for watching and allowing our team to be part of your journey.